Good morning, good afternoon, or good evening, depending on when you are watching this. Hi, I am Hyla, and I welcome you to this brand new CPA series. In today's session, we are diving into the very first class of FAR, Financial Accounting and Reporting, one of the most challenging and often the most intimidating sections of the CPA exam. Whether you are just starting off the CPA journey or coming back after a break, FAR is a section that demands your focus, your strategy, and the clarity of concepts. It is commonly seen as a consistent threat to the students because of its vast syllabus and complexity. But don't worry, that's exactly what we will simplify in this series. So basically, FAR is a 4-hour long exam. It will include your MCQs and the TBS. TBS is the task based simulations. So in this class, I am going to introduce you to what FR is all about, its structure, the types of topics it covers, and how can you approach it strategically. Whether you are a beginner or retaking the sections, stay tuned, take notes, and let's build a strong foundation together. Let's get started with the FAR foundation. Now let's start with the structure of the FAR subject. It is divided into 6 main units that are called as F1, F2, F3, F4, F5, F6, and each unit is divided into some modules. So F1 is all about the financial reporting, and it is divided into 4 modules: M1, M2, M3, and M4. Basically, the financial reporting is divided into 4 modules, plus it talks about the 4 major areas. Sorry, not 4 core areas, it's 3 core areas. And before heading into the 3 core areas, we need to talk about the exam skills now. So FAR core exams blueprint test 3 levels of skills. First is remembering. Remembering and understanding includes only 5 to 15%. You need to recall concepts and grasp their meanings. And the application part of this is 45 to 55%. This is the key. It means understanding a concept and knowing how to apply it in real life situations or the exam scenarios. For example, you are studying the cash flow, and uh, you know how to make it. That is the basic remembering and the understanding. But how you apply the concepts in the questions, that is the application part. Now the analysis part is about 35 to 45%. What does it mean? It means that you can analyze a situation, identify errors or correct entries or classifications. Basically, now you have made the cash flow statement, and now you need to analyze the same, whether it is correct or not, whether you can correct it if it is a wrong. This is the part of the analysis. Now we come back to the areas part. There are 3 core areas. Area 1 is for financial reporting, area 2 is select balance sheet accounts, and area 3 is select transactions. Area 1 basically is the FAR blueprint, covers the preparations, review, and the analysis of the financial statement. These statements can be for the profit and non-profit entities. It includes the general purpose financial reporting, disclosures for to the public companies, including the earning per shares prepared under the FASB accounting standards, financial statements prepared under the special purpose framework as described in a AUC section 800 of the codification of statement of the auditing standards. It includes states and local government concepts also. Okay, so I am giving you just the brief of the core areas what we are going to read in the financial reporting F1 unit. Okay, now the area 2 covers the financial accounting and reporting requirements of the balance sheet accounts. What do you mean by balance sheet accounts? Like the on the face of the balance sheet you see some items that include the cash and cash equivalents, trade receivables, inventories, PPE, investments at fair value, or the AMC method, like the amortized cost method is known also as AMC method, equity method investments, intangible assets. These areas, how do we handle the same, how do we recognize it, how do we calculate it, at what value, like the fair value or the cost, at which method we are going to now we will talk about the F1, that is financial reporting. It includes 4 models: M1, M2, M3, M4. M1 is for the balance sheet, income statement, and comprehensive income. M2 includes the EPS and the public company reporting topics. M3 is for the stockholders equity part 1, and M4 is for the same part 2. Introduction part has been completed, and in this class we are going to learn about the module 1 fully. So we are starting about module 1 of unit 1. In module 1, which is of balance sheet, income statement, and comprehensive income. We are going to learn about 9 topics. 9 topics will be there. One is balance sheet. Second is income statement overview. Income statement comprehensive example. Fourth is discontinued operations introduction and accounting rules. 5. Discontinued operations. Comprehensive example. Six, individual foreign transactions. Seventh, statement of comprehensive income definitions. 8 is financial statement reporting. 9th is other reporting issues. Also, I would like to tell you that I am following the Becker material, which is 1.13 version, which is applicable from the July 2025 onwards. Let's move on the first topic of the module 1, balance sheet. Under US GAAP, general purpose financial reporting is defined as a full set of financial statements plus notes. What includes the full set of financial statements? That is balance sheet, income statement, comprehensive income, statement of cash flows, statement of owner's equity, plus notes. In US GAAP, it is not only the general purpose, there is also a special purpose framework. In special purpose framework, there is a financial statements are based on the cash or the regulatory basis or for the income tax purpose, right? For the contractual basis, whenever we make the financial statement or for a particular reason, like in cash or for the regulatory reasons, for the for income tax department or for a contractors, then we call that statement as a special purpose. In general purpose financial statements, all these 5 documents are included with the notes. So let's understand what is a balance sheet. It helps us in identifying the financial risk. Financial risk can be of short term and long term. Short term shows about the liquidity, and long term shows the potential growth or the solvency. Okay, for an example, a good financial analyst has to do the trend analysis for if the inventory goes up, PPE is also going up or not, the assets are going up, then the sales of the business is also going up. All these things are kept in mind for the liquidity purpose. Okay, what is income statement? Income statement helps us to analyze the performance, risk, and operating risk. A financial analyst looks sales over a period and calculate average sales, then find the standard deviation from the average sales. This tell us the volatility of the sales. Volatility of the operating income also be calculated by finding the standard deviation of the operating income. What is comprehensive income? It includes these are also the certain gains or losses which are directly transferred to the OCI. They are not transferred to the PNL, they are directly transferred to the OCI. And after that, if they are recoverable in nature, then they are transferred to the PNL. Okay, what is cash flows? Statement of cash flow. So first of all, it shows the changes. It shows the changes in the cash flows. Why cash changed? It is an indicator of the quality of earning and the growth potential. It is also an early warning red flag if PP is sold out to pay the bills of the company, then it is not an good for the company. I will not be impressed. So I want to know why the cash is changing. Also, I want to know the quality of the earning, like the net income per the income statement versus the changes in the cash operate cash changes in the cash operational. So if we take an example like the expenses are recorded on the accrual basis and not the cash basis, but the statement of cash flows shows how much cash we have been paid for the expenses. So why there is a difference in the statement of the cash flow statement and the P&L statement? So if we look at the balance sheet, if the sales are growing but the cash is not generating, then it gives a low quality of earning, and vice versa. If the sales is increasing in the balance sheet but and also cash is also generating, then I am impressed. It is a good quality earning. So let me remove all this, so making a space for the owner's equity. So in owner's equity, okay, in the owner's equity, name of the statement is the statement of owner's equity, but in actually it is shown the changes in owner's equity. What are the changes from the opening balance sheet to the closing balance sheet? The difference between the both is shown in this statement. Okay, so basically why the equity changed? It could be changed due to 3 reasons or maybe more, like changes in capital, changes in retained earning, or the accumulated OCI. Now comes to the notes of the financial statement. So accrual basis of the accounting has been followed in the financial statement to understand how the amounts are calculated, what are the methods used for the calculations, like a LIFO method, FIFO methods, weighted average capital, whatever the methods has been used, and how we arrived at calculations. It is all shown in the notes to accounts. Now, entity may be presented at a classified balance sheet that distinguishes between current and the non-current assets and liabilities. When appropriate, a balance sheet presentations based on the liquidity is also permissible. So this is a balance sheet which is based on the liquidity. How do we make the balance sheet? First of all, company's name, then we wrote the balance sheet. It is then as of a particular date. Normally in US it is a calendar year which has been followed, so we will use the calendar year. This balance sheet is based on the liquidity format. So if we see in the order of liquidity, like the current assets, after that investments, after that PPE, intangible and other assets, we can see it is an order of liquidity. Same in case of the liabilities. First it is current, then it is loan, after that it is an shareholders equity, normally all the items of these balance sheets are calculated at the book value, but not all. Like the trading securities are calculated at fair value, accounting receivables are net of allowances, notes receivables includes both current and non-current, both comes here in this category. Available for then inventory, prepaid expenses, investments available for sale securities also at fair value, held to maturity securities, investments in affiliates continuing as an assets like PPE, we called it shortly as PPE, property plant and equipment, land, building, equipment less depreciation. Land is a non-depreciable asset. In the intangible assets, it is an goodwill. Goodwill is also not amortized. Then patents, net of amortization, means kind of it is a depreciation, but we use the word amortization for the intangible assets. Other assets we are calculated in on net basis. Pension and other post-retirement benefit assets, though it is not in our syllabus. Deferred income assets, it is always considered as the long term, non-current. Now come on the liabilities side. Current means 12-month or operating cycle, whichever is higher. The current portion of the long-term debt, accounts payable, it can be verbal. Notes payable, it is written. Permissing note, like promissory note, bill of exchange. Interest payable, salaries payable, unearned revenue. What is unearned revenue? It is you can say it that you have received an income in advance. Basically you haven't provided the services to the customer, so you are liable to provide the services. Before that you cannot claim that it as an revenue, so we book that amount in a current liabilities under the head of unearned revenue. Long-term liabilities, bond payable, deferred income tax liabilities. Also I told you, deferred income tax is always long. Whether it is an asset or a liability, it is comes under the long-term category, though it is always shown on the net basis. Like if we calculate the deferred income tax, if it comes under the asset, then we shows it here, and if it comes under the liability, then we shows it here. We in the balance sheet only one item is there, either it is a liability or either it is a asset. Pension and other post-retirement benefit is also on the net basis, like the gratuity. We can take an example of the gratuity. Let's move to the equity side. Now capital stock, if we make it a shortcut, CAR, capital stock, paid in excess of par. These two, C and A, comes under the known as contributed equity. Why they are called as a contributed equity? Because because of this we issues stock. Now stock can be the preferred stock, common stock. Preferred stock is it has the second claim on the asset, and common stock is after the preferred stock, common stock has the right. Now paid in capital is for the financing. So good news for the paid in capital is we do not have to pay the dividend as it is not an legal liability, and bad news is it normally diluted your return on equity or the earning. Now retained earning is called as earned capital. Why it is? Because through the year whatever we have earned the profit, that comes under the retained earning. And the accumulated other OCI, what is this? It is the accumulated retained earnings from the previous years. Also gains or losses which are directly transferred to the OCI. OCI, this is OCI, we call it in short OCI. Previous retained earning is not included in the OCIs. It is normally, wait a second, let me confirm it. Yes, yes, I was right. So this year plus previous year all comes to the accumulated to OCI. So what is treasury stock at cost? It is a buyback of shares. This item is always in of the negative category. We do not add it in the balance sheet. We subtract it from the equity. We always subtract it from the equity, and it is also called the contra equity. So after that I will add one more topic here, that is the limitations of the balance sheet. Basically in the US system, book value is not the market value. So basically the debt is recorded on the cost, historical cost. It is not always equals to the current liability, because in the current liability there must be interest accrued and other stuff, plus also the discounting rate will if there is a floating discounting rate, there will be more liability or a less liability. So as a financial analyst, a person has to move from book value to market value to analyze the balance sheet. If we take an example of an asset, like in the books of the company, a depreciated balance sheet. So in the books of the company, the asset, if we take an example of the depreciated building on the balance sheet, it could be zero, but in reality the value is much more. Also the measurements are subjective in nature, like making the comparison difficult between the two companies or for the industry. Like the valuation method for the inventory could be LIFO or FIFO. Same for the depreciation, it could be the straight line or the accelerated method. Suppose one company is following the LIFO method and other company is following the FIFO method. Both companies have the different values. One is having the less value and one is having the more value due to the LIFO and FIFO differences. So the comparison becomes difficult. On the note of this topic topic number 1, that is balance sheet, has been completed. Topic number 1 has been completed. So there were 9 topics, right? This topic number 1 has been completed. Has been completed. Let's move on to the second topic, income statement.